SCHD has had a difficult three-year run. From 2023 through most of 2025, it deeply underperformed nearly every benchmark it is measured against. The S&P 500, growth ETFs, even many other dividend funds. And whenever a popular fund underperforms for long enough, the internet fills up with explanations. The problem is that most of those explanations are wrong. I have seen some genuinely baffling takes circulating from other content creators. Explanations that are not just incomplete, but reveal a fundamental misunderstanding of how equity markets actually work. So today I want to clear the air. I am going to spend a few minutes specifically debunking 3 false explanations I keep seeing repeated, then give you the 3 real reasons SCHD has been struggling, and finish with the most important framework for how to think about this going forward. If you own SCHD, this video is specifically for you. Let's get into it. Before I get into the false explanations, let me be clear about something. SCHD is a fundamentally sound ETF. It tracks the Dow Jones U.S. Dividend 100 Index, which selects approximately 100 U.S. companies based on at least 10 consecutive years of dividend payments plus 4 rigorous financial quality metrics: free cash flow to debt, return on equity, indicated yield, and 5-year dividend growth. The companies that make the cut are well-established, financially strong, and demonstrated dividend payers, names like AbbVie, Merck, Chevron, Home Depot, and Verizon. The expense ratio is 0.06%. The 10-year dividend growth rate is approximately 10.6% annually. This is a well-designed fund. The underperformance of the last 3 years is not a sign that SCHD is broken. It is a sign that the market environment from 2023 to 2025 was unusually hostile to the specific kinds of companies SCHD owns. Understanding why, and doing so accurately, is the difference between making a rational long-term decision and panic selling at the bottom of a cycle. False explanation number 1. SCHD is down because treasury rates are staying higher, so investors would rather put their money in money markets for the yield. Let me explain why this makes almost no sense. First, money market funds and dividend ETFs like SCHD are not competing for the same investor or the same capital in any meaningful way. A money market fund is a cash management vehicle designed to preserve capital with virtually no market risk. SCHD is an equity fund that participates in the long-term growth of dividend-paying companies while generating quarterly income. These are not comparable products, and investors do not typically sell one to buy the other in meaningful enough quantities to explain a sustained performance gap. Second, and this is the more important point, higher interest rates structurally hurt growth companies more than value companies, not the other way around. So the claim that SCHD, which is a value and dividend quality fund, did worse than growth funds because rates stayed high is precisely backwards. Think about how equity valuation works. The value of any company is essentially the present value of all its future earnings, discounted back to today at the prevailing interest rate. When interest rates rise, you have to discount those future earnings more heavily, which reduces their present value. Here is the critical part. The further away the earnings are in the future, the greater the impact of that discounting. Growth companies, by definition, are expected to generate the bulk of their value from earnings further out in the future. That is precisely what makes them growth companies. So when interest rates rise, growth companies get hit harder because more of their value comes from distant future earnings that are now worth less today. SCHD's holdings are mature, profitable businesses generating most of their value from near-term earnings. They are structurally less sensitive to rate moves than growth companies. We saw this clearly in 2022 when rates rose dramatically. SCHD held up significantly better than growth funds like SCHG, which fell approximately 28% that year, while SCHD fell only around 3 to 4%. So if someone tells you SCHD is underperforming because rates stayed high, ask them to explain 2022. The math does not support that explanation. False explanation number 2. SCHD is down because people are rotating into AI stocks right now. I want to be careful here because there is a sliver of truth embedded in this. AI and technology enthusiasm has clearly driven the Magnificent Seven higher, and SCHD holds none of those stocks. But the framing that SCHD fell because people were buying AI stocks is wrong in a basic causal way. If investors buy more of one asset, that buying activity increases the price of that specific asset. It does not, by itself, reduce the price of a completely different asset. If someone decides to buy more NVIDIA shares, that does not cause Chevron's share price to fall. There is no direct mechanism connecting the two. What you might argue is that portfolios have finite capital, and investors may choose to allocate to AI names instead of dividend names. But that argument applies to every period in every market. Capital always flows toward whatever is currently leading, and it does not explain a multi-year, consistent underperformance across multiple market conditions. The real drivers of SCHD's underperformance are structural and specific to what SCHD actually owns. Which brings us to the third false explanation. False explanation number 3. SCHD is down because dividend stocks always underperform in booming stock markets. This one is not even wrong in theory, it is wrong in the basic facts. Dividend and value stocks do not typically fall when growth leads. They simply rise more slowly. Look at the long-term chart of SCHD versus VOO over the past decade. Yes, VOO has pulled ahead over the last 2 to 3 years in particular. But SCHD was not declining while VOO was rising. It was participating in the general market appreciation, just less dramatically. The current situation is different and specific. SCHD was not simply lagging the market. It was actively underperforming to a degree that demands a more specific explanation. And that explanation comes from what SCHD actually owns. Here are the 3 real reasons SCHD has been struggling. Real reason number 1. SCHD's largest sector is energy, at approximately 19 to 20% of the portfolio, more than 6 times the energy weighting in the S&P 500, which sits around 3%. The March 2025 reconstitution significantly increased SCHD's energy exposure, adding multiple energy holdings and leaving the fund more concentrated in oil and gas than it has been for most of its history. That would be fine if oil prices were rising. They are not. The global oil market is facing significant supply pressure. OPEC Plus production has been elevated. Russia continues pumping at high levels to fund its war effort. The United States has been increasing domestic production, and demand growth has moderated as China's economy has slowed more than initially expected. The combination of rising supply and softer demand has pushed oil prices into a structurally weak environment. Energy stocks are priced substantially from expected future cash flows, which are directly tied to the oil price. When oil is expected to stay weak, energy stocks underperform. SCHD's 19 to 20% energy weighting in a weak oil environment is one of the clearest and most direct explanations for why it has lagged the S&P 500. Real reason number 2. SCHD owns a significant allocation to financial stocks, particularly regional and mid-sized banks, at approximately 8 to 10% of the portfolio, again meaningfully higher than the broad market. And over recent periods, regional banks have faced specific headwinds. The yield curve has been steepening, meaning the difference between short-term and long-term interest rates has been widening. This matters enormously for banks because their business model involves borrowing at short-term rates and lending at long-term rates. When the yield curve steepens, it is because longer-term rates are rising faster than short-term rates. If a bank is sitting on a large portfolio of longer duration assets, mortgages, treasuries, commercial real estate loans, those assets decline in value when long-term rates rise. The regional banking stress of 2023 was a vivid illustration of exactly this dynamic, and many of these institutions still carry those assets. A steepening yield curve in an environment where long-term rates are rising is precisely the conditions that put regional bank balance sheets under pressure and suppress their stock prices. SCHD's financial sector exposure is concentrated enough to show up meaningfully in performance attribution. Real reason number 3. SCHD holds 0 Magnificent 7 stocks. That is not a criticism. It is a structural feature of the fund's design. The Dow Jones U.S. Dividend 100 methodology excludes companies that have not paid growing dividends for at least 10 consecutive years, and it limits inclusion to stocks in the upper half of yield rankings. Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, and Tesla, collectively the Magnificent Seven, either do not pay meaningful dividends, have not paid for 10 consecutive years, or do not pass the yield screening. They are simply not eligible for SCHD, but those 7 stocks have been responsible for an extraordinary proportion of the S&P 500's total returns over the past 2 to 3 years. By some calculations, the Magnificent Seven alone accounted for more than half of the S&P 500's gain in 2023. SCHD cannot own any of them. So every time Nvidia adds another $100 billion in market capitalization, every time Apple reports blowout earnings and the stock rallies, SCHD does not benefit. Meanwhile, VO and growth-oriented funds like SCHG, which have heavy Magnificent Seven exposure, do. The combination of a 19% energy weighting that is underperforming, a meaningful regional bank allocation in a difficult rate environment, and a complete absence of the stocks driving most of the market's gains, those 3 factors together explain the vast majority of SCHD's recent underperformance. This is called attribution analysis, by the way. It is what institutional investors routinely use to understand why a portfolio outperformed or underperformed its benchmark. And when you do it properly for SCHD, the explanation becomes clear and logical, not the vague, inaccurate reasons floating around the internet. So where does this leave SCHD investors? I want to give you 3 honest points that I think are the most important context for where things stand in 2026. The first is that SCHD is already staging a meaningful recovery. After 3 difficult years, SCHD has returned approximately 13 to 15% in 2026 year-to-date, significantly outperforming the S&P 500, which is down approximately 1.5 to 3% over the same period. The rotation toward value, energy, financials, and dividend-paying companies that many analysts were anticipating appears to be underway. Part of what is driving this is macro uncertainty. When investors get nervous about growth outlooks, about AI capital expenditure delivering on its promises, about trade and geopolitical risks, they tend to rotate toward the more predictable, cash-generating businesses that SCHD specializes in. SCHD is exactly the kind of fund that benefits from risk-off sentiment. The second point is that SCHD's March 2026 reconstitution is expected to reduce the energy overweight and increase exposure to financials and healthcare, 2 sectors that currently look more attractive on SCHD's quality metrics. Healthcare in particular has delivered approximately an 8% 5-year dividend growth rate and offers exactly the combination of current yield and sustainable growth that SCHD's methodology is designed to capture. If the reconstitution plays out as anticipated, the structural headwind from heavy energy exposure should moderate. The fund will still not own Magnificent Seven stocks. That is a permanent feature of the methodology. But the oil and gas concentration that hurt 2023 to 2025 performance should decrease. The third and most important point is about time horizon. SCHD's underperformance over the past 3 years happened in an environment that was almost perfectly constructed to disadvantage its specific holdings. Technology dominance, Magnificent Seven concentration, driving index returns, energy weakness, and regional bank stress all at the same time. Those conditions will not persist indefinitely. Markets are cyclical. Sector leadership rotates. The same way it would have been a mistake in 2022 to conclude that SCHG was a broken fund because SCHD was outperforming it dramatically, it is a mistake to conclude that SCHD is a broken fund because growth ETFs outperformed it from 2023 to 2025. The most dangerous investing decisions come from reacting to short-term performance and extrapolating it into the future. How confident are you that the S&P 500 will be up tomorrow? Honestly, it is close to coin flip, maybe 55 to 45 in favor of up on any given day. How about over the next year? Better odds, but still plenty of uncertainty. Over the next 10 years? I am nearly certain it will be meaningfully higher than it is today. SCHD operates on the same principle. Short-term moves, whether up or down, tell you essentially nothing useful about what is coming next. The structural case for SCHD as a quality dividend growth vehicle with a strong historical track record of both income and total return has not changed. What changed was the market environment between 2023 and 2025. Environments change. Patient investors who understand what they own tend to benefit from that change. Investors who sell after a difficult period and rotate into last year's winners tend not to. If you own SCHD and you have been watching the last 3 years with frustration, the analytically sound response is to understand what drove the underperformance, which is now what you have, and assess whether those specific factors are likely to persist. My view is that they are not, and the 2026 performance data so far supports that. If you are considering adding SCHD to your portfolio, the reconstitution moving away from heavy energy concentration and the current rotation environment make this a more interesting entry point than mid-2025 was. If you found this breakdown useful, the real analysis over the noise, hit the like button and subscribe. Drop a comment below with what question this video raised for you, and I will address the best ones in future content. I will see you in the next one.